In private equity, market downturns have historically been the launchpads for outstanding investment returns. Dr. Smith, could you elaborate on why these downturn periods are often seen as the best times for investment?
Absolutely. Economic downturns like the 2008 financial crisis typically lead to reduced asset valuations. This allows investors to acquire stakes in high-potential companies at bargain prices. For example, investments made during the 2008 crisis, like those in tech startups, resulted in exceptional returns.
However, some argue that such risky times could deter less experienced investors. Isn't there an inherent danger in these buy low strategies, especially with uncertainty permeating the markets?
There's certainly a higher perceived risk. Yet historically, those who strategically invested during downturns backed by data and historical insights have seen immense value creation over time. The key is meticulous analysis of market trends and robust due diligence, akin to the approach seen at NPM today.
As we look ahead, how can current investors leverage historical patterns to navigate today's market turbulence effectively?
Investors should look for parallels in valuation metrics and market behavior. By understanding historical cycles, they can foresee potential rebounds and position themselves strategically despite market volatility.
Let's delve into some case studies. Companies like Airbnb and Facebook saw extraordinary growth post-crisis. What specific conditions enabled their success, Sarah?
Post-crisis, these companies capitalized on market voids. Airbnb addressed affordability during economic recovery, while Facebook harnessed social connectivity as a free service. They had the agility and vision to fulfill shifting consumer needs, positioning them uniquely in a recovering market.
What do you say to skeptics who argue that these success stories are outliers and aren't replicable in today's market climate?
While true outliers, they paved the way for a blueprint of leveraging technological integration and consumer engagement. Today, companies in NPM's late-stage pipeline seem poised to repeat such triumphs by adapting similarly to current market demands.
Given these insights, what potential shifts should investors watch for in the coming years?
Investors should focus on sectors ripe for disruption and companies that address post-pandemic changes. Anticipating future consumer behavior shifts is crucial for identifying the next wave of high-growth opportunities.
Transitioning to valuation, current tech multiples have echoed past lows. Michael, what does this imply for today's strategic investors?
The reset in valuations offers a reset opportunity. Just as seen post-dot-com crash, today's investors have the chance to buy into cutting-edge tech at more attainable valuations, positioning themselves for long-term gains as these assets appreciate.
A counterpoint is the concern over downward spirals. Could the falling valuations signal underlying instability, potentially dissuading investor confidence?
Certainly, not all valuations indicate opportunity. Distinguishing between value and value traps is critical. Meticulous research and understanding of intrinsic value and future growth trajectory help prevent such pitfalls, aligning investment decisions with long-term objectives.
As values adjust, where do you see the most significant investment potential emerging in the near term?
Emergent technologies like AI and sustainable energy solutions are poised for substantial growth. Investors should conduct sector-based valuations to identify early entry opportunities in these high-potential areas. Strategic allocation during bear markets requires diversification and a focus on resilience. While retaining a core focus on defensive sectors, tilting investments towards innovation-driven industries can offer a buffer against market volatility and lead new growth paths.
Critics might argue that maintaining a conservative approach is safer during such uncertain times. How do you counter that perspective?
Investors should focus on digital transformation, AI technologies, and shifts in consumer behaviors post-pandemic. These innovations are likely to shape the investment landscape significantly, evolving traditional strategies into more